Welcome to Inside Networks INBriefs at the Income and Defensive Asset Symposium. My guest today is Reece Birtles from Martin Currie. Welcome, Reece.
Good afternoon, Jamie.
Can you just explain Martin Currie's unique approach to investing in equities?
Yeah, we're looking for growing dividend streams from companies. So we're looking for companies with strong dividend streams that grow over time, that meet the needs of retirement. And we fully incorporate franking credits to consider the low tax status of typical Australian retirees. And we do that in a very diversified, low risk style of portfolio.
Great. You might have answered the next question, but repeatability is really, really important in investment management, and especially my day job is as a financial planner. So my day job is managing wealth for clients. So it's really important in clients' wealth creation as well. How do you maximise the probability of success in executing what you're doing?
Yeah, we do it in multiple ways. From a portfolio construction point of view, we don't want a significant concentration to any one stock or sector. So we don't look at the ASX 200 weights. We look at the maximum weight per stock.
Okay.
Also on a sector basis. We don't want 40% in banks.
Sure.
And then have all the dividends cut on banks in one go. So we have a maximum allocation of 20% to any one economic sector. Yep. So that's at a portfolio
and stock level? What's this?
At a stock level, it's a maximum of 5% per stock.
Great.
And then when we're looking at the individual companies, we don't want to be seduced by the current high dividend that they might have. We want to look at the sustainable free cash flow they have at the low points in their profit cycle. So when commodity prices are low or when the economy is weak, making sure they're not using debt to pay their dividends. So we're looking at that real sustainable dividend paying power of a company. And that's how we really avoid those income shocks.
So off script, does that mean you do a lot of work understanding the company internally of where the cash is going, what's the capital allocation, what's the free cash flow?
Yeah, we have a very strong investment team, average 20 years experience, 17 people focused on Australian equities, and we have industry specialists that understand how those companies evolve. They're doing forward-looking free cash flow analysis, and we have a really repeatable, disciplined investment process that we use across all of our strategies to deliver.
Sounds boring.
Yeah, I know.
But it works, right? So tell us about, I've heard you speak before and you talk about this sufficient income for life concept. Can you explain that to the listeners?
Yeah, so we think during accumulation, everyone's trying to maximise their wealth by the time they're 65, given their risk tolerance. But when you get to retirement, your problems is different.
Sure.
You're looking for a level of income that covers your cost of living needs, and you need that income to grow over time. So the higher that income can be on a sustainable basis and be delivered, the better your standard of living in retirement. So we want to ensure that we can give a higher income stream, that it's diversified to reduce the risk to that income, and it grows to offset the impact of inflation to give people a better retirement.
I bet you've been saying that for years, and everyone would come back to you and say, but inflation, Reece, is 0.1. I don't really need it to grow. But at the moment, there's no more obvious time where you need your income stream to grow in retirement with inflation running like it is.
Yeah, clearly. I mean, the relative merits of an equity income style strategy compared to fixed interest for the last few years has really been about the level of income, delivering a 7% plus yield compared to sub 1. Obviously, with fixed income markets moving quite a bit, they're offering more like 3.5%, 4% income. But is that a real income?
Sure.
Or, because you don't know the inflation rate. If it's over 3.5%, it's not going to be real at all.
And potentially still lots of capital risk in that 3 or 4%. So.
Yeah, historic volatility on fixed income, is generally around 3%. Last year was a double typical year. It was 6% risk and 11% odd drawdown. So the forward-looking scenarios on things like fixed income are very different than the backward-looking.
Yep. So it's my day job is a financial planner. Our clients are in retirement. Majority, 95%, are in deaccumulation. So understand what you're saying. Income stream is super important for those people, and if you can find it from a sustainable growing source, been really hard in the last 5-6 years as rates got lower and lower and lower. So
I'm sure you'd know better than me, but you're probably targeting a drawdown rate, a safe drawdown rate for the portfolio, and that number used to be 6, 5, 4, 3. And the problem with dropping that drawdown rate is it's lowering people's standard of living because they have less income each year. And what we're trying to do with equity income is design a product that has, sustainable dividend stream over 6%. The current yield is expected around 7.5%.
Okay.
So if we can give you that level of income, it means you can have a higher drawdown rate and a better standard of living for your clients.
I explain portfolio management to clients as total return equals income and plus growth.
Yep.
And there's no certainties, but with income, it's more certain than the growth. So a proper portfolio built, you can probably forward estimate the income, with some kind of certainty. Let's say 85% certainty. The growth, no idea what it will look like in 12 months, maybe 5 years or 7 years.
Yep.
And over the last few years, it's been harder and harder to get a number for that I plus G that is high enough to sustain retirement's portfolio. So, we've had to look other ways, other sources, using credit, using equity for income. So appreciate what you're doing there. Just a last question. Tell us about ESG, really topical at the moment in markets. And does your fund look at ESG at all? Does it have an overlay? Do you have a view on ESG?
Yeah. Martin Currie has a very strong approach to ESG. We're AAA rated by UNPRI on our approach to ESG investing. We do integrated ESG. We're looking at governance and sustainability issues for each individual company. We have specialist ESG people, but each of our analysts and PMs are looking at it for each of the stocks in their portfolios. We have very strong engagements on companies to get things done to improve their outcomes. But we also have our equity income portfolio is integrated ESG, but we do have other portfolios focused, more purely on sustainable only investments or ethical investments that might reflect client needs that have certain preferences to avoid particular areas of concern for them.
Great. Thanks for joining us, Reece.
Thank you.